If you think financial crashes are rare accidents, here is the truth that should make you uncomfortable. For more than 100 years, every major market collapse has followed the same exact script, step by step, with an almost disturbing precision. Not coincidence, not bad luck, but a structural sequence understood by Wall Street, by central banks, and by the ultra-wealthy, yet almost never explained to the public. And the most frightening part is not that another crash may be coming, it's that we are already far past the beginning.
Every major financial crash of the last 100 years has not merely rhymed with the past, it has followed the same exact choreography, step by step, like a ritual repeated by history itself, and that alone should terrify anyone paying attention, because this is not about coincidence or bad luck, it is about a structural pattern that has repeated through 1929, through 1987, through the dot-com collapse of 2000, through the global financial crisis of 2008, and now, quietly, methodically, through the present moment as well. A five-stage sequence that begins long before panic headlines appear, long before markets fall apart on television, sometimes months, sometimes years in advance. A sequence that Wall Street understands, that the Federal Reserve understands, that the private wealth managers of billionaires and dynasties absolutely understand, and yet one that almost never reaches the public conversation in any meaningful way, because if ordinary people truly understood how crashes are born, they would exit early instead of late. They would preserve capital instead of donating it to the system during the collapse, and that would break the machinery that feeds on ignorance. Today, I am going to walk you through all five stages, not as theory, not as speculation, but as a historically verified framework that has survived every major financial implosion of the modern era. And more importantly, I am going to show you where we are right now inside that sequence. And here is the uncomfortable spoiler from the start. We are not at the beginning. We are not even in the middle. We are much further along than most people are psychologically prepared to accept. In 1929, before the word crash carried the weight it does now, a man named Roger Babson stood in front of a room full of businessmen and financiers and uttered 9 words that instantly made him a pariah in elite financial circles. Sooner or later, a crash is coming, and it may be terrific. The room laughed, newspapers mocked him, editors dismissed him as a crank, and Irving Fisher, the most famous economist in America at the time, a man whose confidence embodied the optimism of the Roaring Twenties, publicly declared that stock prices had reached what he called a permanently high plateau, a phrase that history would later turn into a cautionary epitaph. 47 days later, the market collapsed. Fisher, who had leveraged himself on the very optimism he preached, lost nearly everything and spent the remainder of his life trying and failing to rebuild both his fortune and his reputation, while Babson, who had been ridiculed for his pessimism, preserved his capital, compounded it through the downturn, and later founded Babson College, an institution that still exists today, a quiet monument to preparation over belief. What almost nobody talks about is that Babson was not guessing, he was not relying on intuition or fear, he had developed a systematic framework for identifying financial vulnerability, one that examined credit expansion, market concentration, institutional behavior, liquidity conditions, and what he called trigger vulnerabilities, 5 interlocking factors that together formed a progression, not a prediction. And over the past 3 months, I went back through Federal Reserve archives, historical market data, and academic research to test whether Babson's framework actually held up across different eras, different asset classes, and different regulatory regimes. And the result is deeply unsettling because it works every single time, without exception. Stage 1 is where it always begins, and it never begins with speculation or greed the way movies portray it. It begins with debt, with a credit explosion that expands faster than the real economy can support, creating the illusion of prosperity while quietly hollowing out the system from within. Because credit allows people to pull future consumption into the present, and when too much future is borrowed at once, the present becomes unsustainable. Before every major crash, households, corporations, and governments take on obligations they cannot realistically service under normal conditions. That borrowed money floods into assets, pushing prices higher. Those higher prices create a psychological wealth effect. People feel richer on paper, which encourages even more borrowing, more leverage, more risk, until the entire structure becomes a self-reinforcing feedback loop that looks like growth but behaves like a trap. In the late 1920s, this took the form of margin debt. Ordinary Americans were putting down 10% and borrowing 90% to buy stocks, a level of leverage that would be considered reckless even by today's standards. And by 1929, total margin debt was roughly equal to the entire federal budget, a staggering statistic that reveals how deeply financial risk had penetrated everyday life. Factory workers and clerks were effectively operating with hedge fund-level leverage, all tethered to the assumption that prices could only go up. In 2007, the mechanism changed, but the logic remained identical. Mortgage debt exploded. Banks engineered exotic lending products that allowed home purchases with no money down, sometimes no income verification. Those mortgages were then sliced, repackaged, and sold as safe securities to pension funds and institutions around the world, hiding leverage behind complexity while spreading fragility across the global system. In 2000, during the dot-com era, the credit expansion flowed through corporate balance sheets. Companies with no profits and often no viable business models borrowed billions using inflated stock prices as collateral, and when those prices fell, the collateral evaporated and the structure collapsed under its own weight. Now, look carefully at today, because this is where historical patterns become deeply uncomfortable. Official margin debt alone sits around $750 billion, but that number dramatically understates reality because it ignores securities-based lending, where wealthy investors borrow against portfolios without selling assets, adding hundreds of billions more in hidden leverage. It ignores the options market, where a relatively small amount of capital controls massive notional exposure, effectively creating leverage on leverage. And it ignores corporate debt, which has surged past $10 trillion, much of it not invested in productive capacity, but used to buy back shares, artificially boosting earnings per share while weakening balance sheets. Then there's government debt, now exceeding $34 trillion, requiring interest payments larger than the national defense budget, a situation that would have been unthinkable in previous decades. And when you aggregate it all, public and private, visible and hidden, total debt as a percentage of GDP now exceeds levels seen in 1929 and 2008, higher than at any point in recorded American history, meaning stage one is not just active, it is overheated, overstressed, and structurally embedded. This brings us to stage two, the concentration trap, a dynamic rarely discussed outside of professional risk circles, because crashes are not caused merely by high prices, they are caused by fragile structures, and fragility emerges when risk becomes concentrated in too few places, when a small number of assets, sectors, or institutions carry a disproportionate share of the system's value, making the entire market dependent on their continued perfection. In 1929, this concentration revolved around glamour stocks, especially Radio Corporation of America, a technological marvel of its time, whose stock rose from under $2 to over $500, fueled by excitement around radio technology that most investors barely understood. And because RCA represented such a large portion of market capitalization, when it cracked, it pulled the rest of the market down with it. In 2000, the concentration lived inside a handful of technology giants. Cisco, Intel, Microsoft, and a small cluster of internet companies dominated the Nasdaq, effectively turning the entire index into a leveraged bet on a few narratives about the future. And when those narratives faltered, trillions of paper wealth vanished. In 2008, the concentration hid within the banking system itself, where a small group of institutions controlled the majority of derivatives exposure, making the system critically dependent on their survival. Today, the concentration is no longer hidden at all. The top 7 stocks in the S&P 500 account for roughly a third of the entire index, meaning that what most people consider diversified investing is reality a heavily concentrated wager on a handful of mega-cap technology companies, companies whose valuations now require flawless execution, uninterrupted growth, and perpetual optimism, a condition history suggests is temporary at best. Passive investing has amplified this fragility because every dollar flowing into index funds automatically buys more of the largest companies, enforcing their dominance on the way up and guaranteeing forced selling on the way down, creating a mechanical feedback loop that accelerates both booms and busts. This is not theory, it is mathematics, and it is exactly how Stage 2 locks into place, quietly, efficiently, and almost invisibly to those who believe diversification alone equals safety.
And here is where tension begins to build, because when stage 1 and stage 2 are both fully engaged, the next movement in the sequence is already preparing behind the scenes, unseen by the public, but well understood by those closest to the machinery of power and capital.
Stage 3 is where the mask finally slips, where the mythology of free markets collides with the reality of power, information asymmetry, and quiet self-preservation. Because before every major crash, there is a period when those closest to the system begin to leave it, slowly at first, almost politely, and then all at once. And this stage is the one that should make you angry, not fearful, because it exposes how the game actually works. While headlines remain optimistic and television panels reassure viewers that fundamentals are strong, institutional investors, banks, hedge funds, family offices, and corporate insiders begin reducing exposure, raising cash, hedging risk, and repositioning for survival, not collapse. And they do it without press conferences, without warnings, and often while publicly encouraging everyone else to stay fully invested. In 1929, this process began months before October. The Morgans and Rockefellers quietly liquidated positions during the summer. Bernard Baruch, one of the wealthiest men in America, was almost entirely in cash by September, and Joseph Kennedy famously exited the market after realizing speculation had reached absurd levels, not because of a shoeshine boy's tip alone, but because his proximity to banking networks revealed tightening credit and growing internal stress long before it reached the public. And while these men prepared, ordinary Americans continued buying, convinced by experts that prosperity was permanent, unknowingly serving as exit liquidity for those who understood the pattern. In 2007, the same choreography unfolded with modern instruments. Hedge funds began shorting subprime mortgages more than a year before the crash. Internal documents later revealed that major banks, including Goldman Sachs, were structuring and selling mortgage-backed securities to clients while simultaneously betting against them. Executives at mortgage lenders sold personal stock at record rates while telling investors everything was fine. And once again, regular people kept buying homes, stocks, and funds, absorbing the risk as insiders stepped away. Today, the data tells a familiar story. Corporate insider selling has reached extreme historical levels. CEOs, CFOs, and board members, the individuals with direct access to real-time operational reality, are selling shares at a pace not seen in decades. The ratio of insider selling to buying has surged, meaning far fewer insiders are willing to put personal capital into their own companies at current prices, while retail investors, fueled by passive contributions, app-based trading platforms, and retirement inflows, continue to pour money into the market, a silent transfer of risk from informed hands to hopeful ones. And this is not conspiracy. It is structure, because markets reward early information and punish delayed understanding. And stage 3 is simply the moment when the imbalance becomes visible if you know where to look. Stage 4 is more deceptive, more dangerous, because nothing appears broken yet. Prices may still rise, volatility may remain contained, and analysts speak confidently about resilience. But beneath the surface, liquidity, the invisible oxygen of financial markets, begins to evaporate. And when liquidity disappears, markets do not gently correct, they seize, they gap, they cascade, because without sufficient buyers, even small waves of selling can turn into avalanches. In the late 1920s, the Federal Reserve raised interest rates to curb speculation, draining liquidity from the system while markets continued rising, creating a false sense of security. And when selling finally began in October, there were no bids. Stocks didn't decline, they collapsed, because liquidity had already left the room. In 2007 and 2008, the Fed had raised rates steadily, credit conditions tightened, but asset prices remained elevated until Bear Stearns failed, then Lehman, and suddenly it became obvious that liquidity was gone. Credit froze, and the market lost half its value in months.
Today, the parallels are impossible to ignore. The Federal Reserve has raised rates at the fastest pace in 4 decades, moving from near zero to above 5% in less than 2 years, while simultaneously conducting quantitative tightening, removing hundreds of billions of dollars from the financial system, and yet equity markets hover near all-time highs, leading many to believe tightening no longer matters, that a soft landing has been achieved. But history suggests this is precisely the moment when danger is greatest, because liquidity effects lag and stress accumulates invisibly before releasing violently. In March 2023, 3 major banks failed within a single week: Silicon Valley Bank, Signature Bank, and First Republic, institutions that collapsed not because of bad loans in the traditional sense, but because rising rates destroyed the value of assets on their balance sheets, triggering liquidity crises. And the Federal Reserve responded with emergency lending facilities, effectively creating money to backstop the system while publicly insisting no bailout had occurred, a semantic distinction that does little to change the underlying reality. These programs are temporary bridges, not structural repairs, and beneath them, deeper fractures are forming, including in the U.S. Treasury market itself, the foundation of global finance, where moments of impaired liquidity have already appeared, a troubling sign in what is supposed to be the most liquid market on Earth. This is stage 4, the liquidity illusion, where calm persists on the surface while oxygen is quietly siphoned away, and it sets the stage for the final act, stage 5, the trigger, the moment that turns vulnerability into collapse. The most misunderstood aspect of crashes is the role of triggers. People assume the trigger causes the crash, but history shows the opposite. The crash is caused by the buildup of stages 1 through 4, excessive debt, concentration, insider exits, and liquidity withdrawal. The trigger merely determines timing. In 1929, the trigger was a relatively obscure British fraud case involving Clarence Hatry, a financier whose arrest forced British banks to raise cash by selling American assets, a small shock that cascaded through an already fragile system and ignited a global depression. In 2008, Lehman Brothers served as the spark, but it could just as easily have been Bear Stearns, AIG, or another institution, because the system was primed to fail. The unsettling truth is that no one can predict the next trigger, and that uncertainty is precisely what makes this stage so dangerous. It could be geopolitical, a financial accident, a sovereign debt crisis, a derivatives failure, a banking shock, or something entirely unexpected. Because triggers are rarely the threats everyone is watching. They emerge from blind spots, from complexity, from overconfidence. What history does tell us is when stages 1 through 4 are fully active, the trigger usually arrives within 12 to 24 months. And with all 4 stages confirmed since late 2024, the window points towards 2025 or 2026, not as a prophecy, but as probability. And that is where the final question begins to take shape, not about markets, but about preparation, responsibility, and choice.
Now, it is crucial to understand what all of this does not mean, because misinterpretation is where fear replaces thinking, and fear is rarely useful. This does not mean the market crashes tomorrow. Timing has always been the graveyard of certainty, and history is brutally clear on this point. Markets can remain irrational far longer than individuals can remain solvent. Anyone who claims to know the exact date of the next collapse is not informed. They are performing. And equally important, this is not a call to sell everything, retreat from society, or hide in financial isolation. Panic is not preparation, and reaction is not strategy. What this does mean is far more uncomfortable and far more actionable. The structural conditions that preceded every major financial crash of the last century are now present, simultaneously and at scale, and that combination is exceedingly rare. All 5 stages are either fully active or imminent, which places the system in a state of heightened fragility, where outcomes become non-linear, where small shocks produce outsized consequences, and where resilience is far lower than surface-level indicators suggest. History does not repeat because people fail to predict the future. It repeats because people refuse to recognize patterns that threaten their beliefs. And this is where the story of Roger Babson and Irving Fisher stops being a historical anecdote and becomes a mirror. Babson did not win because he was smarter. Fisher was arguably the more brilliant economist. Babson survived and thrived because he respected the signals. He understood that markets are systems, not stories, and when systems display recurring stress patterns, belief becomes irrelevant. While others leveraged themselves into the peak of optimism, Babson held cash, accumulated hard assets, and positioned for durability rather than performance. And when the collapse came, he did not merely survive it, he emerged from it stronger. While Fisher, who trusted his models and dismissed dissenting data, lost not only his wealth, but the credibility that had defined his career, spending decades attempting to recover what confidence had destroyed in weeks. The lesson here is not moral, it is mechanical. Crashes do not punish stupidity, they punish unpreparedness. They do not target the reckless alone, they destroy the complacent, the convinced, and the convinced tend to be the most vulnerable because they see no need to adapt. You now stand at the same crossroads, whether you ask to or not, and the choice in front of you is not binary. It is not optimism versus pessimism, it is awareness versus denial. You can look at this framework, at the data behind it, and decide it does not apply to you, that markets always recover, that time smooths everything, that this time is different because technology, policy, or institutions are stronger. And perhaps, eventually, years or decades from now, that may even be true. But recovery does not erase the damage done along the way, and it does not guarantee that your personal timeline aligns with the system's healing. Or you can begin asking difficult, practical questions, questions that most people avoid because they force uncomfortable answers. How much of your total financial life is exposed to market risk right now? Not just a brokerage account, but retirement plans, pensions, home equity, employment stability. How much of that exposure is concentrated in a handful of mega-cap companies whose valuations depend on uninterrupted growth and perfect execution? How much of your future depends on prices staying elevated? And if those prices fell by 50% over the next 18 months, a scenario that has occurred within living memory, what would that actually mean for you? Not emotionally, but structurally. Would your plans be delayed, derailed, or destroyed? This is not about predicting catastrophe. It is about stress testing reality, something institutions do routinely and individuals rarely do. And yet, individuals are the ones who suffer most when systems break. I am not telling you what to buy, what to sell, or how to allocate capital. That would be irresponsible and dishonest. I am not a financial advisor. I am a historian of systems, and systems do not care about opinion. They care about structure, incentives, and math. And the structure right now is fragile by historical standards. The people who were ruined in 1929 and 2008 were not foolish, they were trusting. They trusted experts who assured them everything was under control. They trusted institutions that benefited from their continued participation. And they trusted that if something was truly wrong, someone would warn them in time. But history shows that warnings rarely arrive in clear, comforting language. They arrive as patterns, as signals buried in data, as uncomfortable truths that challenge prevailing narratives. Nobody rang a bell in 1929, nobody rang a bell in 2008, and nobody will ring one now. The warning is the pattern itself, and now you have seen it. What happens next is not predetermined, but your response to what you know now will shape your outcome more than any headline ever could. Because knowledge alone is not power. Applied knowledge is, and awareness without action is just another form of denial. The crash of 1929 did not have to devastate so many lives. The signals were visible, the framework existed, and those who respected it survived. Those who ignored it paid the price. And history, indifferent and patient, is offering the same lesson again. Whether it becomes tragedy or transformation depends on who is willing to see the system as it is, rather than as they wish it to be.